All right, hey everyone, this is Vishal from Uncharted FX, and what a week we had last week, but that's nothing compared to what's going to be coming this week. So, we're going to talk about central banks. Of course, I mean, the title of the video is, Will the Federal Reserve Kill the Stock Market? So if you follow my work, if you follow my blog, or follow me on social media, you know I've been speaking since the beginning of this year, how around March, around springtime, central banks will change their rhetoric. They'll go more dovish, and then by fall, we will be cutting rates. And this is happening. Again, folks, this is essentially, we are heading towards another, I would say, economic crisis, but also geopolitical or political crisis, as well as a social crisis. This happens in human history. It's multiple waves, and I believe we are seeing the end of another soft money cycle. If you look at human history since 3000 BC, we go from hard money to soft money, hard money, soft money, and it's just cycles that keep repeating themselves. But if you are interested in that, check out my work. But for this video, we're just going to be talking about the markets and central banks. So last week, we had the ECB, who are already negative. They came out saying, hey, look, we are going to increase, or we're going to restart the stimulus package, and we are looking to cut rates further into the negative. So this is the thing about the Keynesians. They can never admit that they are wrong. We know negative rates don't work. I mean, look at Europe, look at Japan, look at Switzerland. However, the Keynesians' argument is, no, we just didn't cut more negative enough, or deep into the negative enough, or we didn't print enough money. So they can't admit they're wrong. Of course, you know, this is, if they do, it is a bit of a social, confidence crisis. And a confidence crisis is essentially what I think we're coming up to, and hence why gold, and you could even say cryptos, are going up. And once this confidence crisis occurs, this means that there's a loss in confidence in the government, in the banks, and in the money, the fiat money. And once that confidence is gone, it is very difficult to get back. And I believe this is the reason why you're seeing gold predominantly go up. And I think gold is going to be very bullish in the next couple of months to even years. Again, gold is a confidence crisis asset. A lot of people use the whole inflation hedge argument, I guess. But the thing is, inflation pretty much can be looked at through a psychological lens, and you can argue that inflation is more about people's expectations. So this week we have three more central banks. We have the Bank of Japan on Tuesday, we have the Bank of England on Thursday, but more importantly, and the topic of this video, and the topic that everyone is going to be talking about, is we have the US Federal Reserve speaking on Wednesday, July 31st, and they are expected to be cutting rates 25 basis points. Now, a lot of people, I guess a lot of the academia and a lot of the other Wall Streeters, they find this very strange, because we are cutting rates at all-time highs, where the stock market is at all-time highs. And a lot of these people also say, hey, look, the consumer is strong. Again, they talk about, consumer taking out more debt, or access to more debt, and is able to spend. And also the economic data is not too bad. I mean, like, if you look at the unemployment data is, the employment rate is low. And if you look at NFP, it's generally considered good. And this week, last week, we had the PMI. Not the PMI, the GDP, preliminary GDP for quarter two for America. Quarter one came out at 3.1%. Quarter two came out at 2.1%. However, that 2.1 was greater than I believe it was 1.8% that was expected. So if it is a decrease from quarter one. However, in terms of expectations, it did better than expected. So, a lot of the academic economists and traders are very confused, because, why would the Fed be cutting rates? And again, I've written an article here, and I'll post the link in the description below, regarding why, or top 5 reasons why I believe the Fed will be cutting rates. And we can list them and we'll go through them quickly. Number one, of course, is the bond market. If you look at the bond markets, you know that there is a yield curve inversion. And a lot of banks, I mean, even if you look at the Fed funds rate, it's actually higher than the 10-year, meaning a lot of banks are having a negative carry because a lot of these banks, the Fed funds rate is the rate that banks can borrow from each other through their reserves at the Federal Reserve or a central bank. And essentially, they take a lot of that money and they do put it in 10-year treasuries sometimes. And when the Fed funds is yielding more than the 10-year, there's automatically a negative carry. So a lot of these what the Fed has to do is they're trying to lower the short-term yields in order to make the yield curve look normal again. So that's one reason. Number two, and this is the most likely, is that the real economy is actually not improving. We are either in a recession or already heading in a recession, because remember, recessions are lagging, meaning when a recession is officially declared, we've already been in a recession for 6 months or 2 quarters, because that's the definition, 2 quarters of contraction. And if you look at the data that's been coming out, a lot of the data, especially the PMI, which is the Purchasing Managers Index, which is looking to the future, it's becoming negative, so it's telling you something. A lot of people like to use CPI, but CPI tells you what's already happening. PMI tells you what's coming, and PMI is coming out negative. And in this case, the Fed would want to act quickly. Of course, this goes against President Trump's, the strongest economy ever story. So there is, some reason for the Fed maybe to be a bit quiet on this front. Number three is to help the U.S. government debt as well as consumers. There's so much bad debt out there. Everyone knows about the debt story. So much debt. All we did is paper over 2008 with more debt. And government needs a lower interest rate in order to service the debt, but also consumers, they need to borrow more to live, meaning that they require lower interest rates and access to debt. 4, the Fed has to relieve pressure mostly from the emerging markets. We got to remember that the emerging markets have a lot of dollar-denominated debt. So as the dollar gets stronger, this leads to more problems and plays a factor in these nations to buy oil from Iran because they can bypass the US dollar. So if you look at countries like Turkey and India, whose currencies have been decimated to the dollar, due to the dollar, like their exchange rate, they have incentive to buy from Iran because they don't have to use the US dollar because they really can't afford to buy US dollars. So in this way, the Fed, okay, so let's look at the dollar chart. If the Fed decides to try to cut interest rates, they want to try to bring the prices down. And you can see here, we're actually close to a very big breakout zone. If you follow my work, again, I am very, I believe the dollar is going much higher due to more geopolitical and macro reasons. If you're interested in that, I have an article on that, which I will also post in the description below, and it is on my blog. So again, if we have a lower dollar, that might give incentive to nations like India, Turkey, say even European nations, South Korea, Japan, to say, you know what, okay, fine, we will start buying oil again from Gulf nations instead of Iran because we're comfortable using the dollar. Again, if the dollar keeps getting stronger, folks, Iran will get more customers. They'll be then taking away market share from the Saudis and other Gulf states, and heck, even the Gulf states and the Saudis may even decide to drop the dollar because they can't afford to lose market share. And this is where the Russians and maybe the Chinese would enter and give Saudi Arabia some ease by saying, hey, don't worry, if you do drop the dollar, we will protect you militarily if the Americans decide to counter. And then 5th is more psychological, but the Fed here, they've literally talked themselves into a corner. Stock markets, they really only care about cheap money. You can argue that the only reason markets are at all-time highs is because of the promise of cheap money and basically, the Powell put, right? So there's a central bank put, meaning that these central banks will not allow prices to decline very disorderly. They'll keep markets orderly. And if you also read a lot of my posts, you will understand why I believe markets have to go higher. A lot of money is in the market, especially people who are about to retire, because yields were so low you couldn't really invest in bonds. Real estate sort of got overpriced. The only place to go for yield was stock markets, and this is going to keep continuing as interest rates drop. And even pension funds who are underfunded have been going into the stock market. Technically, they're generally very heavy on fixed income, but because fixed income cannot yield, are yielding very low, they have to make yield. They have been forced to go into stock. So just a big issue. Markets literally have to be managed to ensure people get to retire and pensions are saved. So a lot of issues. And again, the Fed, they have talked themselves into this corner. They have to deliver. If they do not deliver, things will happen. And this comes to our 4 scenarios for this week. Number 1 is the no rate cut. So if Jerome Powell does not come out with a rate cut, again, I believe the market is already expecting a rate cut. This move that we've seen higher is due to people pricing in a rate cut. So I think the rate cut is already priced in, a 25 basis point cut. And if there's no rate cut, I don't think these markets will just fall, but I think they will literally be killed. They will die. I mean, all this market cares about right now is cheap money, and the Fed to help them out to ensure assets keep going up, basically, until it starts to make no sense. So this is the scenario, the no rate cut. I think it's the least likely scenario, and if they do this, it's akin to them pulling the plug, right? So I know a lot of people are very confused. Like I said, the academia people who believe, the markets are at all-time highs. You shouldn't be cutting rates. The data is coming out good. Unemployment is the lowest it's been. However, as I said, they have talked themselves into this corner, and the Fed now has to act. So number 2, the second option is a 25 basis point cut. So likely the market has, like I said, the market's probably already priced in a 25 basis point cut. This is what we've probably seen here for this move up higher. And this is already priced in. So even if the Fed delivers with a 25 basis point cut, I think you can still probably see a fall in the market since the price is already priced in, as I said. The big zone I'm looking here, of course, on the SPY or on the S&P is the 29.55.60 zone, which is a flip zone. It's been resistance and has been support now. So if we do see a break below that, I would maybe consider taking a short. So this is, as I said, already priced in, and likely if that comes out, yes, maybe the market will fall a bit. I don't think it's going to fall as crazy, of course, as no rate cut. I mean, if this one happens, the no rate cut, we might even see trading being halted. But if a 25 basis point cut, I think it'll fall, but that dip will probably be bought up. And number 3 and 4 are very interesting because just seeing what price did this week, perhaps now we are pricing in either number 3 or 4, likely number 3. As I said, I believe in the scenario that are more likely is number 2 or 3. But 3 is already a 25 basis point cut, so that's what the market has already priced in. And basically, Powell will come out saying, hey, look, we're going to cut many more times or another time this year. So that's what the market is, probably maybe pricing in, that there will be not just one rate cut, but more to come. And again, that's gonna the narrative, will have to change about the strongest economy on Trump's side. So it'll be very interesting. So again, this is the rhetoric, right? So if we hear Jerome Powell come out saying, yeah, it's not one and done. We have a few more cuts that we are considering. The market will really like that, and this is what the market may be pricing in. And number 4, a 50 basis point cut rather than a 25. Interestingly enough, the odds of this has actually increased. The probabilities of this has actually increased. So this is a way Powell could surprise the market, because I said, the 25 basis point cut rate cut is already priced in, meaning when he announces it, we'll probably see a fall. However, people will probably step in to buy the dip. But with a 50 basis point cut, it literally surprises the market, and we see, we'd see a big rise higher and into all-time new highs. I think that all-time new highs is still going to come. However, this again is a very unlikely scenario, or unlikely compared to number 2 and 3. I believe it's going to be either the 25 basis point cut or the number 3, the 25 basis cut, and talks of more cuts coming, and it's likely going to be this one. But again, if it's number 1, if there is no rate cut, and again, if you do follow financial media, it's all people have been talking about. Are they going to cut? Are they not going to cut? And there's a lot of people saying there's no reason for them to cut, because again, if they do, it means the Fed is now taking their signals from the stock market when they shouldn't be. They should be focusing on unemployment and inflation and all that kind of stuff, which, as I said, unemployment is coming out the lowest it's been. And inflation, I mean, they're not hitting their inflation targets, but again, this is, this is where the academics and the modern day, I guess, traders disagree, because like it or not, these markets don't really care about PE ratios, forward guidance, and all that kind of stuff. It's just because the stock market is the only place left to go for yield in this interest rate interest rate suppressed world, where interest rates are kept low. Back in the day, if you had $1 million, you could retire by putting that money in a government bond. That would pay higher than 6%, and you would be making 60 to 80k. Let's say if it was 8% as well. Nowadays, if you do that, you're making 25k or less. You can't really survive off that. So that money has been forced to go into real estate. Now, if you retire with even $1 million, it can't even buy real estate in some cities. So what's left? The stock market. And that's essentially where they're forcing people to go. If the Fed starts to cut rates, again, they're forcing people into the markets. So that's it for me. If you like the video, please give it a like. And if you haven't followed my channel yet, please subscribe and give me a follow if you enjoy my kind of work. And my work, I talk a lot about trading and geopolitics, and also what monetary policy and what the future, what's coming down in the future, because I believe we are in a very interesting time period where more books will be written about the next couple of years than any other time in history. There's going to be an economic, a geopolitical, a political, and a social crisis, I think, appearing all at once. So very interesting times. So again, thank you for checking out my video, and I hope to see you guys again. All right, cheers.